Gary says, I'm looking to produce 1K per month with credit spreads. What size account do you suggest? Well, that is a very tough question. It's not tough to answer, but it has layers. Gary, what do I mean by that? In general, there's many webinars on this. We've done it for years. When I target this bull put credit spread, we're seeing some volatility here where some of these positions that have the 85% probability I want on the stock criteria that I want for this particular search, the weekly bull puts, what I tend to average, and this is up and down, but normally what we tend to see, and on Tuesday it might be a little bit lower, but I'm usually in this range. The average return is around 15%, 15.5% on the winners with that 85% probability. Okay, and it's right about, they're right 83, 84% of the time. And when a position goes against me, I look to close it at 50% loss. And the max loss is the difference in strikes minus the net credit. If I hit 50% of that because the stock pulls back, I'll likely maybe close or adjust the position. Okay, but there are times when you see the market pull back. There's a lot of instances, we could talk about September of this year, we talk about October this year. Those are more of a 2 or 3 week period. But there are a lot of sudden glitches. You think back to February 5th through 9th of 2018, start of the China tariff wars, when it just dropped quickly. I was in 3 bull put credit spreads in the time. They had 4 days to expiration on February 5th, and all of them were profitable the day before. When that decline happened on February 5th, all 3 immediately went to a 50% loss. Okay, why is that important? So we're talking about an average here that I look for at about a 15% return with safety. You can say, yeah, well, I could go to a 70, 75% probability and probably see a 20% return. Okay, and you might be right, but we've done the math before in other presentations. The reason why we have this set at 85 is because it performed better than being at a 70 to 75 or 75 to 80 probability over different market conditions. So with this target, that gives you a good idea of what you need. Okay, so in general, I could say that with maybe $8,000, maybe $6,000, you could possibly see very easily 1,000% return, because this is every 2 weeks. So for a month, we might be talking, let's say, 30% if you're constantly rolling the positions, and 15% the first 2 weeks and 15% the next 2 weeks. But here's the real thing, Gary. If you're going to trade credit spreads, you're going to set up a portfolio for credit spreads, position sizing is the most important key. For example, my portfolio is mainly made up of about 50 to 60% of married put positions with single-digit risk, using the blueprint and the 12 different income methods. 15% of my total portfolio is allocated to bull put credit spreads. Do I have a better return on bull puts than I do with married puts? In general, yes. And you look over the last 3 years, it's true. Okay, I get more of a return. So why am I not flipping? Why am I not at a 50% of my capital into bull put credit spreads, or 60% or 80%? And because there are times, for example, when that whole portion of my portfolio that I had allocated to bull put spreads was down 50% in one day. Why did I close them all at 50%? Because 2 days later, they were all at 90% loss. That would have taken out my entire portfolio had I held them in those cases. And it comes up, once every 8 months, there's just that sudden downturn where you have to scramble to close the positions, bull or bear. You get a sudden spike, and we've seen those too, where bear call credits have been taken out too, Gary. So position sizing is the key. Only 15% of my portfolio was allocated to this, so that when I lost on all 3 of those positions because of that unexpected event and that volatility, my whole portfolio is only down 7.5%. Half of the 15% total I'd allocated to bull puts, each of them lost 50%, is only down 7.5%. Position sizing is key. Why am I going through this? Is because I don't know your net worth, Gary. I don't need to know your net worth. But I would never tell an investor ever that if you're looking to try to generate a 20 or 25% return with leveraged spread trades, and your goal is to make $1,000 per month, and you say, oh, well, I could do that if I put $5,000 into it. At some point, that's going to be down 50%. And if that's all you're trading with, and I know it's not probably, Gary, but if that's all you're trading with, that will come back to haunt you. Okay? You want to focus on maybe 3 or 4 positions, but position sizing is key. And the amount that you're allocating to any kind of leverage spread trade, I'd say even the calendar spreads that we were looking at for David earlier on, should only be about 10 to 15% of your total portfolio because of that leveraged risk on the position. Our targets are, around this area, 15.5% return here, depending on which positions. I haven't seen Nike come up in a while. That's pretty interesting. That's right at about a 15.9% return. The credit's only 28 or 30 cents, but that's for, of course, a 2-point strike difference in this example. That's what's giving us that 15.9% return. Okay. So again, every 2 weeks, let's say you're averaging 15%, excuse me. So that might be 30% on your capital over the course of the month. That tells you how much you'd want to maybe apply to it to earn the 1,000. And that's with safety. That's 85% probability. But there will be times, Gary, when you will be down 50% on those leverage spread trades. That's just the way that it works in those situations. Okay, so those are my thoughts there, Gary. William there adds a topic. He says if Gary used your bull put credit spread trades and methodology, he would need to allocate around 20,000, 19,000 to generate $1,000 a month. And he says this does not take into account compounding. Okay. And okay, so that's William's thought there. So I was looking, if I did 15%, of course, I think I gave him a number of 8,000 at one point. But I was talking about for every 2 weeks, of course. So he mentioned $1,000 per month. So we're doing every 2 weeks there. So I think I mentioned 8,000. And that would give us, oh, why is my math terrible today? You know why, William? It's Friday. So the 8,000 I took with a 15% would be 1,200. Okay, in that case, that's the number that I came up with to average 15% return on those 3 spreads. Fully invested, the 8,000 would be about the 1,200, and that's why I mentioned dropping it down to 6,000 because that would be 900 roughly every 2-week cycles in that case to look at it. And I think what I was doing, unfortunately, was taking into account compounding in my mind when I made that statement in that case. Oh, David, real quick while we're here, he says, is there a quick way to get the percent probability above on an existing position, such as the bull put credit spread? Yes. In any strategy such as the spreads, the calendar spreads you were talking about, you can select to have the column added right there. There's my percent probability above for the bull put credit spread. For the Netflix, would be selling the 520, buying the 517.50. Net credit of 50 cents, 25% return, and that's an 87.2% probability above the short put. That's the important one, the pivot we want to talk about. I'm sorry. There you go. So there it is. The percent probability above equation right there in any search. Covered call, calendar spread, naked put. What you can also do is if you're just researching the position, you can go to the research tool for the long or the short option. This gives you all of the data that we have, including the probability above, implied volatility range, of course, your delta, gamma, theta, and much more, and some other information over here on the left also. Okay. On an existing position in the portfolio as well, we go back here, and there it is, the Greeks view, David. So when you go into the Greeks view in your portfolio, you've got the probability in the money. I'm sorry, I'm trying to highlight it, but it keeps moving it. You've got the probability in the money, the delta, of course, as well. They're kind of similar, but very different. So for my DAR short call, my collar position, I've got that 70 call. DAR is at 69.07. It's for next week. And it's at a 42% probability that'll be in the money. And then, of course, a delta of negative 0.44. It's negative against me because I sold that call in that case. So that's how you can quickly see it. Or again, from here, link directly to the research tools just to look at the option leg. Sorry about that. One leg at a time there to see all of that information. But you can just do it in the portfolio. In the Greeks view, you're all set in that case. All right. So second, David. We get there, and then we've got William, and then we've got Fernando. All right, so this is a different David. David R. He says, I'm concerned about entry points. I'm sorry, I'm concerned about entry point to a stock. I look to increase in volume over average volume. What is a good source for the data? Concerned about entry point to a stock. I look to increases in volume over average volume. What is a good source for the data? Okay, well, on Power Options, one thing that we show, you could use this maybe in a covered call screen or married put position, David, if that's what you're interested in. You say that you like to use volume over average volume. Well, in the stock technicals here, that is the percent stock volume. I'm sorry about that. This is today's total stock volume compared to its 90-day average stock volume as well. So if I want to see positions that are in the 90th percentile or higher of their trading average over the last 90 days, I'll just put in a percentage stock volume of 90. And of course, Ernie's little suggestion there's a 150% stock volume would mean the stock is trading with 50% more volume. Let's do that. Let's see if we have anything on this default search, David, that's at 150% stock volume. Okay. I almost said Excelsius. Excelsius Car Gurus, First Horizon National Group, Jefferies Financial. All of those have at least a 150% stock volume there as an indication. Okay, so we have it right here for you. The percentage stock volume is showing you the volume today over the average volume over time. And the increases, you look for over 100%. The example we just ran, we did 150% here. Oh, I'm in naked puts. I thought it was, I am covered calls. I'm sorry. We are in covered calls there. So we just took the default covered call, David, added in that percentage stock volume in the technicals field to see positions that have a higher volume today. And you could still, of course, screen for the average stock volume. If I wanted that to be at least, 1 million or 750,000, we could start there. But the percentage stock volume, that's a good data source to use. Of course, you may want to look also for positions that had a recent MACD crossover that went from negative to positive in the last 2 or 3 days that are showing more strength. We also give you the ability to screen by Bollinger Bands, where I can look for stocks that are showing a Bollinger Band breakout to the top or to the bottom for bearish positions potentially as well, David. Okay. So that's all right there for you in the search, the percentage stock volume. You could use it in conjunction again with the average stock volume to see that also. And then, of course, the other technical indicators where you can screen Bollinger Bands, MACD signals, and maybe the number of days the stock has crossed a 50-day moving average, the number of days the stock 20-day moving average has been over the 50-day moving average, David, as well. All right. So that's just some of the ideas that we like to use. And as we mentioned when we were in bull puts, I should have mentioned it there. One of the filters that we use in that default weekly bull puts there for the stock technicals is looking for stocks that have been over, the MACD has had a positive crossover for at least 3 days or more. It's just another thing we look for in the strength, and that was tested. This default setting here for the weekly bull puts was tested using Bollinger Bands, looking for MACDs that have crossed with under 2 days, just had a positive cross in the last 2 days versus ones that were 3 days or more. We ran various tests over a different market for a variety of different criteria. And this structure here, this setup here, worked the best for us consistently for our target goals. It might not be your target goals, David, but they work for our target goals. But again, in any strategy, whether you're just looking at stocks, you're looking at covered calls, you're looking at married puts, David, percentage stock volume is available there for you. All right, so I'm going to take Fernando's question first, and then we'll get right to William. Fernando's question is related to the search in a sense. We're going to use a long call search here. And Fernando asks a question. He says, on Power Options, how could I find the cheapest call on a specific stocks in terms of IV across all expirations? No problem. It's manual, but it's easy to do. We're going to use the long call search. And what we're going to do, of course, as always, Fernando, is clear the filters. Okay, it's going to empty everything out. Now, I'm going to set the time frame to all expirations. You don't seem to have any concern about how deep in or out of the money it is. but we're going to put in some basic restrictions for this exercise. I'm not going to go more than 40% in the money or more than 40% out of the money. Okay? Also, I'm going to make sure that there's some activity on these positions. We're going to put in a basic open interest of 50 contracts, and we're going to put maybe an option volume today. No, we'll leave the option volume out. I'd like to have option volume, but we're going to leave that out. And gonna make sure now, not going to use that price there, but I do want to see some activity. So that's good. We'll do it that way. Okay. Now, I'm going to change the sort first to, it's funny that those are all there, but the static one isn't. We're going to find implied volatility. There's a stock volatility. There it is, implied volatility. And we're going to change the triangle. See the triangle over here? We're going to change it from the shortest to highest number. That's how I'm going to change my sort. Just static implied volatility. Not looking at time value. You're just talking in terms of IV. And then we'll go into fundamentals. And I'll just type in Apple. I may have more than 600 results because we didn't do any filters. Yeah. So strangely enough, well, okay. Let's go at least 5 days out so we're not seeing today's options that you can't trade. They're naturally going to have the lowest IV. So the lowest static implied volatility we see right here is around the 137, 7 days out in time. Okay. And then it just keeps going up. We start to get into 14 days out and so forth and beyond. So if you're looking just, it's not the cheapest cost necessarily, but by the lowest implied volatility, Fernando, that's the easiest way to do it. Then you can start tweaking other ranges, or you want to be in or whether you want to be out of the money. Another thing you might use for guidance, we talked about it a moment ago, using the volatility skew in that signature tool. Now, this can be done two ways. You can look at a static expiration for all strikes. So if I was targeting March, for example, what this shows you, of course, is the skew. There's a big dip here, so there's probably some errant data on the 45 strike that's deep in the money. But this shows you the IV of the options at the various strike prices. Red is puts. I'm sorry, red is calls, blue is puts. Okay, so you can kind of see here that right at the money has the lowest implied volatility for the March series in this case. Now, you could also do the time skew, but that's just picking one particular strike. So if I wanted to use Apple across the entire strikes, we'll use the 135. What did we just see? Exactly what I just saw in the search that we created, Fernando. That the lowest implied volatility for calls and puts is in the next few months, and then you see it start rising. I think you're asking sort of a different question, though, which I don't have for you. I can show you the search there that we just did. We can look for the positions we were talking about that have that sort of rank when you're ranking the lowest, not the implied volatility range, but just the lowest volatility there that we saw with Apple. But I think you're doing a secondary equation where you're trying to compare the volatility to time. But this is how you could set up the search to see it. And if you thought to yourself that you're looking to buy because you're going to be buying 45 to 100 days out in time, change the expiration in that case. And then you can start seeing, again, change the sort to implied volatility, change the arrow to go lowest to highest. And you see here that the April 145 has the lowest volatility of the criteria we did between 45 to 100 days out in time. Okay, and 63 days out. I'm sorry, 48 days out. That's the April 1st. My apologies. Not the standard expiration. That's 63 days out in time. All right, so the volatility skew might be useful for what you're doing, Fernando. Check that out. Play around with it. Let me know if it's meeting your needs there to give you some guidance in that case. And that's the easy way to set up the search. Just clear the filters out directly. Put in some basics. Put in some activity. Put in your stock symbol under the fundamentals tab. And then change the sort to lowest to highest. If you wanted to search by delta, lowest to highest or highest to lowest, follow the same thing. Just sort by delta. And then put it in the radio if you want highest to lowest or lowest to highest as well. Moving. Fernando says the maximum quantity of put or call that you can buy on a stock are limited/related to the max available quantity of stocks in the market. And that is relatively true because as we're buying calls and we're buying puts and we're doing things of that nature, Fernando, the market maker is doing potentially different things in between. What do I mean by that? Let's say that you buy a put and I sell a put. I enter a naked put and you buy a put, and we have the same strike, same expiration, and same time frame. And there's a buyer for a seller at this point. But you as the option buyer, did I say you're the buyer? Yeah, you as the option buyer, more than likely you have no intent on forcing me to buy shares of stock, unless, of course, you're in a married put position and you want to exercise it. You bought the put to take the profit on the leverage position. The market maker knows something. He knows that you're likely to sell to close that put at some time when your profit is reached, and they're likely to have an imbalance. Okay? He's not necessarily going to exercise me right away if you sell to close your put and he has a slight imbalance in that case, because what he's doing is going long stock and short stock to cover the two obligations if he starts to see those imbalances, or when those positions are put in, to hedge himself. Might even be doing a covered call position if you're buying a call in that case, so he's got the stock and the call as well. So there is action that's being created with stock ownership a lot of times when these options trade hands in the background to hedge themselves, to cover themselves in case there does become this out of leverage, if the option sellers really start to sell to close all of their positions. And we saw an issue with this. What happened, of course, with GME a couple of weeks ago, Fernando, is that when the short sell started to hit, one of the exchanges, mutual funds, one of the mutual funds was doing it just with options. They were short calls and long puts. And as the stock started to move up quickly, they had to cover the short calls, essentially going, in that case, they had to do the transactions there with the puts and the calls and potentially buy stock as well as sell stock in those situations. So it was very interesting in that scenario what happened. But there was one of the mutual funds that had a big bearish position. It wasn't something Lakeland or Lake, anyway. That were using options, and they had to end up using the stock and their other options positions to hedge out of that bet as well. But there should be a cap, because there should not be more options that are available than shares can be purchased. Maple Creek, William says this, I think is the one. But there should not be more call options out there than stocks that can be made available for the owners. And a lot of times the market maker in the background is doing those transactions to make sure things are accounted for to hedge themselves as well. Okay. All right. And then William, let's see here. You've got a quick follow-up, it looks like. He says, for a long option position, long call debit spread, do you have a rule of thumb regarding time left to expiration? Will you bail on the trade if it hasn't hit your target price, say 15, 30, 45 days away? Yes. And it depends how long you originally started it. Mine's 45. Okay, and sometimes it's 30, but really mine's 45. 30 days is the lowest I would go. And the reason why, it's right on my desktop, isn't it? Hold on, I know I've got the screen paused, folks. I can't do that with this here. That's a shame. No, it's fine though. Give me 1 second. But anyway, think about the time decay curve. When do you see the most rapid time decay? It really, really starts in that last 30 days. That's when it's really, really fast. And so that's what you want to try to get out before you lose all valid time that you may still have left in those positions. Okay, so that's my general rule, is that when a long position, oh, come on, computer. There it is. Yay. Okay. There you go. So I know I need a better image, don't I? I'll get a better image. This is zoomed, so it's even worse. But you really start to see that last percentage time decay, William, that's the last 30-day mark. That's the rapid decay. So 45 is usually where I like to be. Two rules of thumb of that, like the married put I had on AEM, which was near maximum loss because it had a 20% decline. It really fell fast, and then it never really moved up. I didn't want to use income method number 9 to increase the risk. I meant like a 7% loss on this trade. And I'm coming up 20 days to expiration. And why am I not closing it? Why am I not closing? It's because earnings went today. What happened if it moved up 15%? I'd only be at a 4% loss or 3% loss. If it happened by the luck of the gods to move up 19%, I would have been at a positive return. I'm already at near max loss, got 15 days to go. Earnings are coming up in 11 days. Why not? Why not just wait? So I did, and the stock fell 5%, so it was a pointless move. Got to close out AEM, take the 7.5% loss in the position. That's the only reason why I would hold something longer, is that if I'm already near the maximum loss in the position, I haven't adjusted it, something happened and it got away from me, but there's an event coming up in the last 30 days before the expiration, even 10 days before expiration, even 5 days before expiration, why not? I might get lucky. I accepted I could take the maximum loss when I opened the long call. I didn't want to. I let it get away from me. Here I am at an 85, 90% loss, but an event is coming up before the expiration. I'll hold it longer just in case. Usually it doesn't work out that way, but that's all right. So that's my rule. It's usually about 45 days. In the married put position in the blueprint, the exiting the RPM chapter, William, you'll see us talk about, we talk about there that for a married put, normally if it's not going the way we want or we've achieved our goals, we'll either close the position or roll the put further out in time if we want to continue the position when we're at the 60-day mark. 60 days to expiration is when we'll look to do that, because we know what's going to happen to whatever put value, whatever time value, we still have in that put in those last 30 to 45 days. Okay, so my target's usually 45 in the kind of positions we're talking about. That's assuming that I bought something that was 120, 160 days, 180 days out in time. If I bought a 90-day call out, which I do from time to time as well, yeah, 30 days, not 45, not half. I haven't given enough time to really go in the direction I want to maybe maximize returns. So I think, William, it's also, well, for me personally, it's also related to the time frame I selected. I had mentioned earlier with the, I can't remember whose conversation was. It was Gary's or Bob's. Oh, was it? Yeah, I think it was Bob that asked about the return. That's right. It was Bob that asked about the return. And, I said I had speculated with some long calls here and there. When the market hit the bottom in March and we started to see those buy and light buy recommendations in the market sentiment, between that time and April 10th is when Ernie and I were buying calls out to January of this year on the bigger stocks. We were buying Apple, the ones that you knew would likely recover, the bigger tech stocks. He did Facebook, I think. I looked at Apple. He looked at Microsoft, and you saw the other presentation where we talked about those long calls as well. But other times, I just have a good feeling about a stock, and I think it was in December. No, it was November. I can't remember. I think it was November. My apologies. And I bought a December call on Goose. I think it was Goose, the company I know that I used to trade as a married put back, and it went up and it gave me the return that I wanted. And I closed it 10 days before expiration because it was only 30 days out to begin with. And I reached my target. That was a little lottery ticket play saying, I think it's going to go up 7 to 8%. And it did. And I took my profits off of it that I was targeting, which is about a 70% gain on the call. And it was small money. It wasn't a big portion. I think it was less than 1% of my total portfolio, to tell you the truth. That's a different scenario. What you're talking about, of course, is for these long debit spreads, buying long calls for a longer term investment or part of a calendar spread. 45 to 60 days is what I look for as the right answer. And then you'll be able to streamline it for those shorter positions you might be taking later on as well, if you decide to do that. If you decide to do gamble a little bit with some of those shorter term trades that I tend to do, but it's very, very small, insignificant portion of my portfolio. It's to keep my head in the game and learn more lessons, honestly. I'd have to say it that way, is why I do it that way. For those other smaller positions, William, in that case also. All right. Well, ladies and gentlemen, here we are at about 6:06 p.m. Eastern Time. And I'm just going to transfer the screen over now, of course. I want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. Options do involve risk, as we talked about today as well, and may not be suitable for all investors. We did some work on the search tool today, both for Fernando, and we discussed some of the other features on the search. We looked a lot at the portfolio tools today for analyzing liquidation value, future expiration value. Didn't set any alerts, but that's a possibility too. We looked at some of the signature tools when we were reviewing for James, some of the best ways to use the tools also. Like what you saw today, remember you can take a 14-day free trial at any time. Just go to PowerOp.com, put in your name and email address, and you'll have full access to the site for 14 days. Access to the search tool for all 23 strategies, as research and analysis tools we looked at, signature tools, portfolio tools, and much, much more. After the 14-day free trial, the services start at just $45 per month for the end-of-day data subscription. And of course, the upgrade to that is the delayed service. Slightly delayed data is only $65 per month. We, of course, offer a real-time service, and a small upgrade from the delayed service, $35 more, gets you delayed service plus full access to the historical backtesting tools and all the years of data that we have there as well. We talked about the free education earlier for James, that webinar on your one-stop shop for options investing. Again, the free webinars page, PowerOpt.com/webinars.asp. You can go through the different strategies and go through the different tools. And of course, go over to the YouTube channel at any time, just Power Options on YouTube. All of our Friday sessions and segments of our Friday sessions are posted there public, as well as other presentations. You can search on the channel for common terms, covered call, option premium, debit spread, credit spread. You'll see all the videos that we have available for the different strategies or the different topics that meet your needs. Now, if you think of any other questions, and we did cover all of the questions that came in, but if you think of any other questions later on, remember you can send us an email at any time to support@powerop.com or support@radioactivetrading.com. Of course, you can also call us during market hours at 302-992-7971. There's contact links all over the page as well. And of course, if you're on that trial, or if you're a subscriber, you can schedule a free coaching session at any time. That's essentially a 40 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. All right. Well, ladies and gentlemen, I think that's going to do it for today. I hope you all have a fantastic weekend and an extra day to relax with President's Day. Don't have to worry about thinking about the market. I'm sure I'll probably be doing some work on some videos there. Kip, it's great to see you here too. He says, great session. Have a relaxing and safe President's Day. Kip, you do the same. And William, thank you for your questions. Fernando, thank you for yours, of course. And David, the two Davids, David via email, of course, and David R., who asked the question about the percentage stock volume. And Bob and Gary, thank you all for the conversation. Everyone have a fantastic weekend. Stay safe, stay healthy. We will see you soon. Take care now. Good night.